Hi, and welcome to another edition of CGL Online Tax Tips. Today, I want to talk about whether or not a business should incorporate and whether or not that's right for you. It's a question that many people get asked when they're looking at setting up their business, and they hear from their friends on Coffee Row that they should set up a corporation. And so we want to make sure that you're going in their eyes wide open before you take the big leap into setting up a company. So there are many pros and cons to setting up a corporation, and there are many misunderstandings as well. Some starting points to consider are: what is my net income going to be? And will I hire staff or subcontractors? Do I plan on splitting the income with my spouse after the tax profits? Will I need all the money personally to pay down expenses, debt, that are non-business related, or can I afford to leave it in the business to help it grow, or defer it until I need the money at a later date? And ultimately, do you want a tax plan? So going to the first part here is, what is my net income going to be? And the main advantage of a corporation is not tax savings, but rather tax deferral. It is true that on paper, your taxes will be less on the income inside a company, but how do you take it out? When you take it out, you still have to pay personal taxes on that money, even though there's been tax paid in the corporation, unless you pay yourself a wage. If you're paying yourself a wage, chances are you're not getting the benefit of a company, no different than if you were a proprietor anyway. So there isn't as big of an advantage. Also, you get subject to this nice little thing called reasonability when it comes to owner-manager remuneration. For the most part, the CRA has been administratively accepting things like bonuses and stuff like that to the shareholders or to the owners, provided that the business is ongoing. There is some caveats with that, in that it's quite common that we see people paying their spouses who may not be active in the business. And the problem with that is that obviously if there's no work done, without trying to be a little bit correct here, without saying they don't do anything, but if there's no active employment type of work being done inside the business, and they're not listed as the director or anything like that, it is a little harder to justify the wage. And what can happen is that in rare circumstances, it depends on the luck of the draw of the auditor and how much they don't like you. In rare circumstances, is that it will be income to the spouse as earned income, as a wage, as employment. However, the corporation may lose the deduction as reasonability under Section 67 of the Income Tax Act. And so what happens is the company doesn't get a deduction, therefore they're still paying tax, plus the spouse might be paying tax on it personally. And so you kind of lose some of that income splitting benefit with poorly planned wages. So do you want wages or do you want dividends? And what are the tax differences of each? And for the most part, if you're under the age of 35 and you're going self-employed, we strongly recommend dividends as far as your tax planning needs. You're looking at paying both sides of the Canada Pension Plan approximately $4,300 a year in 2014 for both the individual, your employment side, and the employer side. What happens is you fast forward to when you go to collect and you retire, and that Canada Pension Plan that you paid into all along gives you the same check as your buddy who's the same age and was an employee all his life but only had to pay half as much. So when you look at what's the best bang for your buck, it might not be the CPP for the self-employed person. We usually recommend that you save for your own retirement one way or another, so you add that $4,300 in addition to either your tax-free savings accounts or RSPs if you have the room currently, or even just to other types of investments, or leaving it inside the company and eventually turning it into a holding company. And if you fast forward 20 years, it's a little easier to go to a bank and say you've got $100,000 saved up for that down payment on your vacation property when you're looking at retiring, as opposed to saying that you might be able to collect the CPP someday. So even from a wealth accumulation standpoint and family planning, for long-term estate planning, we usually don't recommend the Canada Pension Plan to those under the age of 35 who are going self-employed for the remainder of their careers. If you've been self-employed for all your life and you've paid in all along, then it might be a time to look at different options or that. But for the most part, we usually like some sort of dividend type of planning. But if you want to contribute to the Canada Pension Plan because you think it's the best thing out there, then You can collect it when you retire, or you're disciplined enough to save for your retirement. That is basically, if you want to contribute to the plan, you got to have paid wages. If you don't want to contribute to the plan, you take out dividends. And the biggest savings in doing that is going to be the Canada Pension Plan. The tax and genes in Alberta is pretty much equal. So is the reduced amount of taxes in the company, so 14%, 25%, compared to personal income tax as high as 39%, is it enough savings to cover the increased cost of things like bookkeeping, expensive accountants, and legal fees? And do you want cheap advisors or quality ones? The reality is that we usually don't recommend to our clients to even consider a corporation until their net income is somewhere in the neighborhood of $70,000. Because then really that's when the advantages start to make sense, especially if you're able to live, if you're not needing all the money to pull out to make living costs or to pay your living expenses. The biggest advantage of the company, like I said, is the deferral. So will you hire staff or subcontractors? Liability is a bad word and cannot be avoided simply by incorporating. However, where a corporation can protect you is if you have in forms of liabilities if you have others working for you. So performing your work yourself does not necessarily change the fact that you're personally liable for anything you do. As a result, your actions can still cause some sort of liability, and so you're not protecting yourself by setting up a company. But if your staff do something that can cause a lawsuit, then that corporate barrier does help you out, unless there is some sort of negligence on your part as a director. So payroll withholdings and GST liabilities inside the company are also liabilities of the director. So if you don't pay your taxes that are trust funds on behalf of the government, they will come after you personally. So make sure the government pays first. They are the biggest collection agency that will make your life miserable out of any of the ones that are out there. Lawsuits for damages are usually submitted against the company if something goes wrong, but also the person who actually did the damage. So make sure you have enough insurance policies in place if you are in a high-risk type of earning environment. And if you've got staff and subcontractors that may cause some sort of liability to you, then you want to make sure that you have it properly planned when that might be where you look at a corporation, even if your net income is lower. Do you plan on splitting the income? Well, we already talked about how not to split the income with a large wage to your spouse or your kids or anything like that. So what we like to look at doing is maybe taking advantage of lower tax brackets, using dividend planning and that type of thing. There's also other types of tax minimization strategies that involve family trusts for the little bit more aggressive and high net worth types of individuals. But again, the costs of implementing those types of things are quite high, so you want to make sure that the dollar amount that we're talking about, or the tax savings that we may be talking about, is greater than the cost of implementing those types of structures. Anybody can have lots of companies. The question is whether or not it makes sense. Okay, as mentioned earlier, the biggest tax advantage is the deferral. By leaving money inside the company, you can reduce your yearly tax bill and allow for reinvestment in your business on a tax-efficient basis. Alternatively, there is no real tax savings if you take all the money out of the corporation every year. In fact, increased operating costs would actually make it more expensive to be a company. So if you only take out what you need to live off, maintain your personal checking accounts and not increase your personal savings, but rather use the corporation as your giant savings account for long-term planning, then there's ways to play the tax bracket so you kind of even your tax levels year after year, as opposed to having the peaks and valleys that could cause some more problems. And do you want a tax plan? Many people can fill out forms and be a tax preparer at the end of the year when it's too late to change anything. Effective tax advice and business planning in advance can give your business a competitive advantage and ultimately increase your wealth. I'm Corey Litzenberger with CGL Strategic Business and Tax Advisors, reminding you, use your accountants.